Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, and I'm going to be explaining step by step why I think the next bear market that we're going to be seeing possibly in late 2022 is going to be very similar from a macro standpoint to the 1937 to 1940 crash that we had here. Throughout this video, I'm going to show you exactly why the current macro environment is extremely similar to this period here leading up to the top in 1937, what kind of warning signs we're getting, and of course, how we're adapting our strategy to that environment. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. We make these videos multiple times a week, covering the stock market, covering cryptocurrencies, and putting everything into a historical context. Because by looking at history, analyzing history, you can infinitely expand your experience level on the market by learning from things that have happened in the past without necessarily having to go through them yourself, especially when they're painful events like the 1937 crash. And now, without further ado, let's get right into it. All right, so we're going to begin by taking a look at the similarities that we have from a macro standpoint between now in 2022 and 1937, or at least leading up to 1937. Now, of course, in the 1930s, that was following the Great Depression, right? Following the 1929 crash that really bottomed in 1932. This was a very deflationary macro environment with a lot of difficult economic conditions. And so the government and central banks responded to this environment in three big ways. First of all, they lowered the rates to zero, right? So in 1929, the 3-month Treasury bill rate was near 5%. And during the crash and leading up to the bottom of the 1929 crash, they lowered the interest rate down to zero because the economy was so desperate for money. And when you lower the interest rate, that increases the demand for credit, and it theoretically creates a boom. It increases demand and stimulates economic activity. So that's the first thing they did to recover from the 1929 crash. So first response, lowering rates down to zero. The second response that we had from central banks and the government was quantitative easing. So the Fed began to purchase Treasury securities. So that's the second response that we had to the Great Depression in 1932. And then the third big response was the increase in the federal debt to GDP, right? Look at this. This is 1929 right here, the bottom in the federal debt to GDP. And then between 1929 and 1936, the federal debt to GDP went from around 16% to 40%. So they quadrupled the debt to GDP ratio. So that's the equivalent of doing a lot of fiscal spending, a lot of government deficit. They had a lot of brand new infrastructure plans under President Roosevelt. And all of these responses triggered an economic boom. Now just hang on with me just a couple of more minutes. This is all going to make sense very soon. They created this economic boom that fueled an absolutely historical run on US equities that rallied around 300% from the bottom of the Great Depression. And they had a surge in inflation, right? Look at the inflation rates in 1934. They were at around 5.5%. In 1937, also around 5%. That was in large part led by the high growth that we saw on the M2 money supply. Now, does everything I just said rhyme with anything that you know has happened throughout the past couple of years? Because it absolutely should, although the chart doesn't look the same at all. What happened since the COVID-19 pandemic has been eerily similar to the 1930s. Now, a lot of experts have been talking about this. All of those things that I just mentioned happened throughout 2020 and 2021 ever since the COVID-19 pandemic. We saw the federal fund rate get brought down to zero throughout the pandemic. We saw a historical amount of treasuries being purchased by the Federal Reserve, so that's QE. And of course, we saw the federal debt to GDP absolutely explode. So these are all very similar to the 1930s. In fact, the consequences were exactly the same. We saw an economic boom with stocks rallying hard and a surge in inflation, up to 5% inflation rate, driven by the money supply growth rate. Now, a lot of people have been talking about this. A lot of people have been talking about the similarities between now and the 1930s. But what we're going to do in the rest of this video is try to use that information to forecast exactly what's going to happen and also what's different and what it means for the next few years of investing and trading in the stock market. By the way, if you're so far enjoying this video, make sure to smash that like button as hard as you can. There's hours of research and preparation that goes into making these videos so that you guys can have the best potential content from us. And that's all for the price of just a couple of seconds to hit that like button and of course that subscribe button if you haven't already. Now, at the beginning of 1937 here, following the high inflation readings that we just talked about, the Federal Reserve decided to begin rate hikes. And so this is that same chart of the 3-month Treasury bill rate, and it shows you that spike in the rate in 1937, the very beginning of 1937, showing you that the response to that inflation that we talked about in the 1930s was monetary tightening. And of course, if we take a look at the chart of the Dow Jones, you can see the rate hike corresponds to the exact top of the stock market, and it triggered a very rapid unwind in the Dow Jones. So this is really the first point that I want to make, is that even though the Fed has been doing QE, even though there's been a lot of fiscal stimulus, ultimately they can and will raise rates if that's what they think they should do. Now keep in mind, this was just a few years after the Great Depression. The Federal Reserve tightened monetary policy despite having just had one of the worst downturns in history in the rearview mirror. So if you see people putting out the argument that now they have QE and fiscal spending and so they're going to prop up the markets forever, nope. All right, they had QE in the 1930s. They could still tighten monetary policy and trigger a recession. Or that they'll use the pandemic as an excuse to never tighten again. The Federal Reserve has many times in its history tightened monetary policy despite violent economic shocks in its rearview mirror. In fact, towards the end of 2021, they announced that they were going to begin a rapid switch in monetary policy and begin a tightening cycle in response to the elevated rates of inflation we've had throughout the past few months. So here they raised rates in an environment that hadn't completely recovered from the Great Depression, and here they're raising rates in an environment that hasn't completely recovered from a global pandemic. In fact, if you take a look at the University of Michigan's consumer sentiment, it's incredibly low here, right? That's telling us that the average person is not in a stable financial situation, is not optimistic about the future, and is definitely not ready to endure a monetary tightening cycle, which is what we're about to see. Now, I said I was going to say what's different, and I'm going to quickly go over the difference between now and 1937. First of all, that we saw inflation rise a lot farther and a lot quicker than we did in the 1930s. Now, that's of course because of the pandemic that has caused additional supply chain issues that, on top of the money supply growth we've seen, has contributed to a huge disequilibrium between supply and demand and has caused inflation to absolutely skyrocket even faster than in the post-1929 world, in the post-Great Depression world. And so while between 1933 and 1936, it took 3 years for the Fed to switch from extremely easy monetary policy to hawkish monetary policy, here it only took 1.5 years. And that's because of those stronger inflationary forces. So the first difference is because inflation is a lot more aggressive now because of the pandemic, this economic boom that we're seeing is very likely to be a lot shorter than the one we saw in the mid-1930s. Second difference, stocks were a lot less overextended in the 1930s. Look at where they were here in terms of PE ratios. They were overvalued at around 23 of price to sales, but here we're now getting closer to 40 of price to sales ratio. So that leaves the stock market a lot more vulnerable to more downside in the next downturn. Another big difference is the private debt to GDP. This is actually the individual person's debt burden. And so when there's monetary tightening, it really affects the balance sheet of individual people. If society has a lot of private debt and you've got tighter monetary conditions, you've got a recession, you've got lower liquidity, asset prices that begin to go down, it's a lot more likely to be very violent if there's a lot of private debt relative to people's ability to service that debt, which is GDP, which can be taken into account by using GDP. Now, in 1937, you had around 80% of private debt to GDP. Now, according to Trading Economics, we're at around 235% of private debt to GDP in the United States. Now, I don't know how accurate this source is, but the point is that private debt to GDP is definitely a lot more elevated now than it was in 1937. So once the momentum switches from a macro standpoint, I think that we're heading for a similar bear market to 1937, a rapid unwind. And I don't like to say this because I often get a lot of criticism when I do. People don't like to hear bearish news or bearish research. The only analysis that really gets a little bit of credibility online are the ones calling for upside, and the ones calling for downside are called crazy doom and gloomers. But I think the next bear market is going to be a lot worse than 1937. I think the differences that we just discussed leaves the door open for much more downside than what we had in 1937. Now, we talk about this extensively on our website at gameoftrades.net. We recently made a video on gold, a hedge against an overextended financial system. I think this is going to be one of the greatest wealth transfers in modern economic history, but the timing of this trade is absolutely essential. We discuss our exact strategy regarding precious metals, the equity markets, and cryptocurrencies, and how all of those pieces fit together in this video. If you're interested in finding out more about our long-term investment strategy and how we view the macro environment, how we protect ourselves, and how we intend on taking advantage of all of these developments, don't hesitate to check out our free trial. There's a link down below. Click on it and you'll have access to a free trial. We're really trying to make our service the best research platform for convictions, analysis, macro investing, and trading strategy for the average investor. I guarantee that you guys will not be disappointed with the service. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on the like button to let us know and to support the channel, push our videos out to a new audience. Now, in the meantime, I wish you good luck on your trading and see you next time.